Gold and silver markets have always been fascinating, but what's happening now is unlike anything we've seen in years. The world of precious metals isn't just about buying and selling. It's about understanding where smart money is flowing, where risk is hidden, and how opportunities emerge in the chaos. Right now, only a small fraction of players, about 10%, are truly performing at a high level. These top performers have honed their strategies, learned from past mistakes, and are leveraging the market better than ever. And the rest? Well, they are still figuring it out, often struggling with outdated methods or reacting too slowly to shifts in demand and supply. One major factor shaping this market is the role of institutional money. Big investors are entering the gold and silver scene more actively than ever, though sometimes the way they participate is different from what we might expect. For instance, institutions rarely ask for certain perks like warrants, which smaller investors might chase. This changes the dynamics of the game, affecting everything from pricing to liquidity. It's a reminder that understanding the market isn't just about watching prices. It's about understanding the behavior and strategies of the people behind the money. Governments and public funds are another layer of complexity. While some advocate for pension funds and public money to enter the market, history shows that this can be risky. Often, government involvement doesn't align with the best interests of taxpayers. Money that could grow organically in the hands of skilled investors may instead be misallocated, reducing overall efficiency. From a market perspective, this kind of capital is considered dumb money, and it can create distortions that more experienced players need to navigate carefully. Jurisdictional risk is also a hot topic in precious metals investing. While it's tempting to look for safe countries, the truth is, every jurisdiction carries some level of risk. What matters more than politics or perception is the quality of the deposit itself. High-quality gold or silver deposits can thrive even in challenging or unstable regions, whereas mediocre deposits in stable areas rarely generate significant returns. Investors who focus on deposit quality rather than geopolitical headlines tend to outperform consistently. Oil and gas markets have parallels here too, showing us how supply constraints and strategic underinvestment can create opportunities. The same principles apply to gold and silver. Understanding production cycles, evaluating available resources, and anticipating demand are crucial. In the silver market, for example, retail demand is creating shortages in smaller, deliverable products, while institutional supply remains abundant. Recognizing these gaps is key for anyone aiming to profit without getting caught in market noise. The reality is, smart investors who stick to fundamentals and maintain patience will come out ahead. There's no overnight fortune here, but a methodical approach, analyzing supply, institutional behavior, government policy, and geopolitical factors, provides a roadmap for success. For viewers looking to understand these dynamics, our channel Gold Silver Scope dives into these details every day, helping you see through the hype and make informed decisions about gold and silver investments. When it comes to silver, one of the most important things to understand is the difference between retail supply and institutional supply. Right now, retail investors are feeling the squeeze because small, deliverable silver products, from 1-ounce coins to 1-kilo bars, are in short supply. This isn't because there isn't enough silver overall. In fact, institutions and big trusts have access to plenty of silver in bulk, which they can move easily. The real challenge is at the retail level, where physical silver is scarce. Dealers are working hard to convert non-deliverable silver into good delivery bars, but this process takes time. For anyone trying to buy silver for personal investment, patience and planning are essential. Understanding these supply dynamics can prevent frustration and help you take advantage of real opportunities. The concept of a silver squeeze gets a lot of attention, but it's important to separate hype from reality. Exchanges like COMEX are owned by members and can suspend contracts or cash-settle trades when positions get too extreme. That means physically catching a major dealer short is practically impossible. History in other commodities like tin and nickel shows us that exchanges will intervene before investors can fully exploit shortages. So, while media stories about silver squeezes make headlines, the practical takeaway is to focus on real, deliverable silver rather than paper contracts. This approach minimizes risk and positions you to benefit when supply catches up with demand. Gold, on the other hand, is experiencing steady interest globally. Countries like India continue to shape demand through government policies, import regulations, and local market practices. While India's long-term policy is sometimes unpredictable, its role as a major buyer of gold creates recurring opportunities for smart investors. Small shifts in policy, taxes, or trade rules can significantly affect retail margins and pricing, which savvy traders can monitor closely. Staying aware of these patterns allows investors to anticipate price movements instead of reacting after the fact. Another important factor is understanding how banks and financial institutions interact with precious metals. For example, gold and silver can serve as collateral for loans, giving investors access to working capital while holding onto their metals. This is particularly valuable for businesses that need short-term liquidity, such as real estate developers or traders. By using bullion as security, investors not only protect their assets, but also leverage them to grow wealth strategically. The key is choosing partners who understand the market and can act quickly when opportunities arise. Macro conditions also play a crucial role in shaping the precious metals landscape. Inflation, interest rates, and currency devaluation all impact gold and silver differently than traditional assets. Many conventional inflation measures understate the real cost of living, so investors who pay attention to true purchasing power, looking at housing, taxes, groceries, and energy costs, can better anticipate market reactions. Precious metals have historically served as a hedge against these pressures, making them attractive during periods of uncertainty. Geopolitical events and global crises add another layer of complexity. Supply disruptions, wars, or sanctions in major producing regions can create temporary shortages or price spikes. For example, when critical trade routes are blocked or mining operations are disrupted, both gold and silver can see sudden movements. By staying informed about these events and understanding their implications on supply chains, investors can position themselves to benefit while avoiding unnecessary risk. Finally, the long-term outlook for gold and silver remains positive, but patience is essential. Expecting overnight gains or dramatic price doubling in a short period often leads to disappointment. Instead, focus on fundamentals, deposit quality, supply-demand balance, institutional participation, and macroeconomic trends. By doing this, investors can gradually build wealth without falling prey to speculation or hype. The market rewards those who remain level-headed, informed, and prepared to act strategically when opportunities arise. In the next part, we'll explore actionable strategies, what to expect in the months ahead, and how to make the most of the gold and silver market while staying safe. We'll also cover some important warnings and practical tips that every investor should know. As we look ahead, the gold and silver markets continue to offer significant opportunities for those who approach them strategically. One of the key lessons for investors is to avoid overreacting to short-term hype or sensational news. Precious metals, unlike traditional stocks, are influenced by both physical supply constraints and macroeconomic factors. Retail demand, institutional holdings, government policies, and geopolitical events all combine to create price movements that may seem unpredictable, but they follow clear patterns if you know what to watch. For silver, the current shortage of physical deliverable products makes planning essential. Investors should consider building positions gradually, ensuring they have access to products that can actually be delivered. This is not the time to chase paper contracts or get caught up in speculation about squeezes that may never materialize in the way mainstream media portrays. Instead, focus on accumulating tangible silver while keeping an eye on institutional trends and upcoming regulatory changes that may influence supply. Gold remains a steady store of value, but opportunities exist beyond simply holding the metal. Monitoring global demand, especially from major buyers like India and other Asian markets, can provide clues about potential price movements. Small changes in trade policy, import taxes, or market practices can create significant advantages for those paying attention. Additionally, gold can serve as a collateral tool, allowing investors to leverage their holdings for business purposes, short-term capital needs, or strategic investments without selling their bullion. This dual role as both an asset and a financial tool makes gold particularly versatile in uncertain times. Macroeconomic factors continue to shape both markets. Inflation, interest rates, and currency depreciation influence the real value of your holdings. Many official inflation numbers underestimate the actual rise in everyday costs, so it's crucial to look beyond headlines and examine real-life prices for housing, energy, groceries, and taxes. Gold and silver have historically outperformed fiat currencies during periods of devaluation, making them reliable hedges for preserving wealth over the long term. Geopolitical risks also play a role. Disruptions in mining regions, trade routes, or political tensions can create temporary price spikes. While these events may seem alarming, they also present opportunities for informed investors to position themselves advantageously. Understanding how these external events impact supply and demand can make the difference between short-term losses and long-term gains. Looking forward, patience and strategy are the ultimate keys to success. Avoid chasing unrealistic predictions or overinflated expectations. Focus on quality deposits, solid institutional demand, and supply dynamics. Maintain a long-term perspective and prioritize informed decisions over emotion-driven trades. If you follow these principles, the potential for steady growth in your gold and silver investments is very high. For anyone watching and looking to stay ahead in the gold and silver markets, remember, consistency, research, and smart planning are your best tools. Keep learning, keep observing, and avoid shortcuts. And for daily updates, analysis, and insights into gold and silver, make sure to follow our channel, Gold Silver Scope. Here, we break down the market in simple, actionable terms, helping you make informed decisions without confusion or hype.